Now, since I went through that, what I want to do is I want to go through the stock market game plan for the remainder of this year. Okay, what is my game plan? What is my game plan? What am I thinking about? What am I looking? What am I looking at? And I'm gonna go through this in real time with y'all to let y'all know what I'm thinking. Okay, now, first of all, the first thing I want to say is this before we even go into anything further. Continue to long-term invest. All right, make sure you are continuing to long-term invest. Okay, you should be buying the S&P 500 every single month, dollar cost averaging and building a position. That's what's going to allow you to build wealth over the long term. Okay, if you are a person that does research and knows how to invest in stocks, you should be buying companies that are undervalued, that have strong balance sheets, and that you can be in over the long term. If you do not quite know how to do that yet, you should be buying the S&P 500 and dollar cost averaging in a separate account and be able to manage the portfolio for yourself, right? Because if you got a 401k and you're investing into it, you're investing into some variation of the S&P 500. Okay. I also need you to know that the stock market is for everybody. Okay, the stock market is for everybody. It's not just for the rich and wealthy. Okay, this is a vehicle that is here for us to be able to build wealth. Okay, I don't want y'all to be intimidated about the stock market. I want you to understand that you can use this stock market to use the resources to really truly build the life that you want. That's why I created this brand, why I created the t-shirt. Don't pay for it, trade for it. I literally want you to go into the stock market, invest, trade for the long term, and take those profits to pay for the things that you desire. Understand that the stock market is for you. Investing is for you, right? Even if you're only investing to the S&P 500, the stock market is still for you. So please keep that in mind. Now, number two, this is the thing. Understand this. Now this is a major key. Understand that the Federal Reserve's decisions are the number one indicator for whether stocks will go up or down. Now, if you've been following me for a while now, you know that I've been preaching the Fed to y'all, understanding that the economic data is so much important to y'all. But I'm going to tell y'all why the Federal Reserve decisions are so important. It's because of this. The Fed controls interest rates. Okay, right? So if the Fed controls interest rates, what do interest rates do? Interest rates affect the ability to borrow. Now, people borrow for different reasons, right? The federal funds rate affects the ability for banks to borrow from each other, but they also affect people's ability to get auto loans, credit card interest rates, all that type of things, right? So the ability to borrow affects investors' appetites to invest for growth and meet demand. Okay, so investors are going to hesitate when interest rates are higher, because when interest rates go higher, that increases the cost of borrowing. Now, investor hesitation affects commodity prices, right? It affects commodity prices. because demand's going to fluctuate, supply and demand, right? So understand this, commodity prices affect the cost of goods. Okay, so the cost of the goods that we have, the commodity prices cause that stuff to fluctuate. Okay, the cost of goods. The cost of goods affect consumer spending. If the cost of goods at the grocery store are increasing, consumers have to eat. So they're going to spend more money at the grocery store, but they may spend less money on apparel. So if that happens, consumer spending, what does consumer spending affect? Consumer spending affects companies, can affect companies' revenue and profit, right? Because if consumers are spending more or less, it's going to affect the amount of profit that it has, and company revenue and profit, and company revenue and company profit affect stock prices, right? Because if companies cannot pretty much have the amount of revenue and have the amount of profit that investors anticipate happening, that's going to affect the stock prices. So now, like I said before, I'm not an economist, but this is just a small little flow chart that I use to make it make sense to me, to kind of break it down to y'all to kind of see why the Fed's interest rates decisions can affect all of this stuff that's going on, right? The Fed's interest rates decisions can affect all this stuff, and it's in a flow chart. There's some things that you can add here, some things you can take away, but this flow chart pretty much tells you what is going to affect interest rates and why the Fed is the number one indicator for whether stocks are going to go up or down. Now, number 3, this is another major key. The Fed funds rate, right? Let's look at the Fed funds rate, right? Like we talked about earlier in the video, the Fed funds rate right now is at 2.25% and 2.5, between 2.25% and 2.5%. That's neutral policy. It's not accommodative, nor is it restrictive. But for every 1% increase in the Fed funds rate, that equates to a 10% downside risk in equities, right? Which, i.e. stocks, right? Now, let me go to the chart and let you know why this makes sense. Now, I'm finna go to the chart real quick, let you know why this makes sense, okay? Now, let's look at, now this is SPY, this is the S&P 500. Let's see what the performance has been over this year. How low have we gotten on SPY? So from our all-time high all the way down to our year-to-date low, SPY was down as much as 24.5%. So remember what I said, for every 1% increase in the Fed funds rate, that equates to a 10% downside to equities. So if we're at around between 2.25% and 2.5%, that means that the stock market has already priced in what the Fed has done to this date, right? The market's already priced in what the Fed has done to this date. Now, remember what I said earlier. I said that the Fed is not going to be having another interest rate decision until September. And so we're going to have another round of economic data, right? That economic data, we're going to get 2 inflation readings. We're going to get at least 3 job number readings, and we're going to get some other manufacturing and other economic things that's going to tell us what the Fed is going to do. Now, the Fed may reverse course The Fed may reverse course. Also, remember, how much higher do you really think we're going to go on the Fed funds rate? Look at this chart. For my traders, remember, we're approaching a double top. The Fed may go above 3%, but we're not going to 4%, y'all. We're not. So if we did actually get to 3%, we could look at equities coming down 30%. That means that a good downside measure for equities would probably be around 30%. So that means we could look at the stock market coming down to about a level of 335. Now what does that level put us at from a long-term perspective? Let's look at the 5-year chart. Let's look at the 5-year chart and let's draw the Fibonacci, right? Let's draw our Fibonacci retracement levels. We always draw our Fibonacci retracement levels from our all-time high all the way down to a major low, right? So Fibonacci, this 335 would put us below the 50% retracement, which is really where you want to be really considering buying heavy stocks here. But understand where this 30% downside in equities lines up with. This 30% downside in equity lines up directly with an all-time high. What? The all-time high that occurred before COVID, right? It lines up directly with that all-time high. So when you look at that, a potential bottom could potentially be 335. That could be a potential final bottom. Now, we've got a lot of different risks that are going on in the economy. Inflation could continue to stay high, which could make us come down and retest this level, right? We've got midterm elections, politicians, that tends to have volatility in the market. We could come back down and retest this level. The Fed could say, hey, we're going to raise up to 3%. We're going to raise 3.5 to 3.54%. That's going to put us all the way down right here. So what I'm looking at is, once we get through all this economic data through September, through October, what I'm looking at, I'm trying to navigate volatility, okay? I'm trying to navigate volatility and find good price points to purchase options contracts that expire in 2025. Now, I've got some questions in the chat very quickly. To fight inflation, would the Fed funds rate have to increase to above the inflation rate? In the 80s, Fed funds rate was nearly 20%. I do not think that is going to be needed, right? Runaway inflation, we are not in that same period anymore. Okay, I believe, in my opinion, 9.1% was the peak for inflation. If we go up a little bit higher, we will not get back to where we were in the 1980s. And the Fed funds rate does not need to get above inflation in order for the Fed to be able to tackle it. The main thing that's going to allow inflation to come down is an increase in the federal funds rate. Increase in interest rates was going to cause investors to stop borrowing, right? To pause borrowing. Also, remember commodity prices. I talked about this last week or a couple of weeks ago. Commodity prices have fallen significantly. US oil, cotton, copper, wheat, natural gas, right? All these have fallen significantly, right? 26% on wheat. We're down. Okay, so natural gas is actually back up from where it was, but it was down negative 32%. But natural gas is coming back up again, and we're having like a double top. So that's one thing we need to watch. Copper, where's copper at? It's still down it's still down more than 22%. Cotton was down 11%. It's retraced a little bit, but I think it could come back down, right? Let's look at corn. Corn is still down 24%. Oil is still down 22%. So our commodity prices are down, which I believe are driving down inflation, and it's driving down the demand. And so I believe that eventually the supply chain issues and everything that's going on is eventually going to alleviate itself. Now, because that's very, very important. That was a great question that you asked, because a lot of people really truly need to understand what the Fed is doing and how to play this. Now, let me go back to my note screen really quickly here. And let me finish off pretty much with what I was about to say. Now, like I said, that Fed funds rate, this is very, very key. This was something that I really didn't become conscious enough until this year. This could have saved me some money, okay, if I would have been paying attention to this and focusing on the economic data. Now, what am I looking to do? Number 4, what am I looking to do? I'm looking to navigate the volatility in the market, right? And start looking to purchase option contracts that expire in 2025. Now I know that this is mainly for my traders here, but I promise you, over the next 40 to 60 days, I'm going to be giving you guys the options blueprint. Okay, I'm going to be giving you guys the options blueprint and showing you guys what I'm thinking about doing this year in terms of options. But now, right now, the stock market has had one of the worst years it's had in a long time. Okay, but I don't believe that we're going to stay this low for as long as what everybody is saying. I'm trying to purchase options contracts because I can purchase options contracts for cheaper, and it can give me a better return in a shorter amount of time. And I'm trying to play out for as long as I can to allow all of these risks to eventually play out, because once we get to 2024, that's going to give me the opportunity to collect a lot of profit. Now, depending on my strategy and depending on my entries, this is giving me the ability, right, to have diversification in my portfolio. Remember what I said in rule number 1. Rule number 1, continue to long-term invest. You should be buying stocks and adding them to your portfolio. S&P 500, NASDAQ, Russell 2000, long-term companies that you've done research in, Apple, AMD, Microsoft, Google, Tesla, NVIDIA, right? Amazon, okay? That's Nike, right? Those are what you're looking at. Now, what I'm saying is, for myself, I'm taking a percentage of the portfolio, and now we're navigating the volatility in the market and starting to look to purchase options contracts because the market's been down so much. Now you would say options contracts are very risky, right? What are the risks? What are the risks that are going on in the stock market right now that I believe will have been alleviated over the next 12 to 18 months, right? Inflation, right? I believe that inflation will be alleviated over the next 12 to 18 months. We're not going into runaway inflation. Eventually, inflation is going to come down. Once inflation comes down, that's going to increase investors' appetites to invest and their ability to borrow, right? What's another risk, right? The Fed raising interest rates, right? That's a risk. The Fed is going to stop raising interest rates eventually. They're not going to raise interest rates into perpetuity. When they pause and they stop raising interest rates and leave them where they are, and they start cutting interest rates, stocks are going to move higher. You heard it here first. When the Fed stops raising interest rates, when the Fed stops raising interest rates, raising interest rates and starts cutting them, stocks will move higher. I believe that's going to happen over the next 12 to 18 months. That's why I'm purchasing options contracts that are going to expire in 2025, to give me time, give me the diversification, give me the ability that I need to move and pivot and do what I need to do. Okay, what's another risk? Russia-Ukraine war, right? The Russia-Ukraine war. I believe that this conflict is going to subside eventually. It's going to subside eventually because it's just not going to last forever. And if it doesn't subside eventually, what's going to happen is the market's not going to care about it anymore. It's going to be similar to like the Iraq war when we were over in Afghanistan. Eventually, investors aren't going to care about it anymore. Like what's going on in Russia and Ukraine right now is not really affecting how the market feels about the stock market right now. Like for example, like everybody thought wheat was gonna just cripple the entire global economy from a commodity standpoint, but wheat's done fell down a lot. And so I believe the Russia and Ukraine war is eventually going to subside still. Okay, what's another risk? We talk about inflation, we talk about interest rates, we talk about the Russia and Ukraine war. Okay, supply chain issues. Supply chain issues, right? Supply chain issues. Eventually, this is going to be, this is all temporary, right? It's just taking a lot of time. COVID really, truly messed up the supply chain. Too much demand, too much going on. Eventually, this is going to alleviate. What's another risk that's really truly been affecting stuff, especially in China? COVID. Mandatory COVID lockdowns and other health emergencies. I think this right here is going to eventually alleviate itself as well, right? All this stuff is going to eventually work itself out and alleviate itself. Now, the reason why I'm trying, so this is the thing. So if I'm buying options contracts in 2020, if I'm buying options contracts that expire in 2025, what I'm telling you is that before the end of this year, I'm positioning myself to go long, right? I'm positioning myself to be long the market because I understand the market is going to go back up over time. These 5 risks I've got: inflation, the Fed raising interest rates, Russian war, Ukraine, supply chain issues, mandatory COVID lockdowns and other health emergencies, and currency exchange risk, right? That's the last one I want to touch on. This is the last one, currency exchange risk. So if you look at the dollar versus looking at the yen versus looking at the pound versus looking at the peso and all these other currencies, right? These are major corporations in the United States are doing major business outside of the United States. I want to say it's between 50 to 60% of the business that United States companies, they do it outside the United States. So the thing is, the dollar in terms of currency exchange is now worth more than what other currencies are outside the United States. And so since the dollar is worth more, they're going to be using their currencies, which are worth less, to purchase our things. And then we're going to convert that over into dollars. So we're going to report earnings in dollars, but they're actually going to be less earnings because the global currency is not worth as high as what it used to be. So that's a currency exchange risk that's going on right now, but it's not something that's going to last forever. Okay, so this is my stock market game plan for the remainder of this year. These are the things that I'm looking at. These are things I'm watching. The first thing I understand is that I'm going to continue to long-term invest. I'm going to continue to buy stocks because I understand that my long-term self is going to thank me later for buying stocks now. Understand, the stock market is for everybody. It's for you. Okay, the stock market is for you. You do not have to know about global currency exchange risk like I do in order to be able to invest into the market. All you got to do is buy the S&P 500 every single month, allocate a portion of your budget in order to do that, and you'll be completely fine. This is not just for the rich and wealthy. When I found this tool in 2020, I found this tool and I understand that I could use the stock market to allow myself to have financial freedom. Okay, number 2, understand the Federal Reserve's decisions are the number one indicator for whether the stocks will go up or down. Look at this flow chart. This is the key. This is the flow chart, understanding the price and demand. Now, like I said, I'm not an economist, but this is in general how the economy works. What's affecting what, right? If you went back into reverse and everything was going good, stock market would be going back higher. Number 3, the Fed funds rate. For every 1% increase in the Fed funds rate, That equates to a 10% downside risk in equity. So it's very, very important for you to pay attention to what the Fed is doing, how they're raising interest rates, how investors are going to take that, because we're going into September, because August is historically a good month for the S&P, but we're going into September, a historically bad month. We're going into October, which could be a weak month. And we're going to November, which we have the midterm elections, which is going to increase volatility. So I may tell you that number 4, I'm looking to navigate the volatility in the market and start looking to purchase options contracts that expire in 2025. What contracts am I looking for? I'm betting on technology. I'm betting on consumer discretionary, right? Consumer discretionary. I'm betting on semiconductors, and I'm betting on the market itself. The market itself. I'm betting on the total market. These are the industries I'm looking to be trying to purchase options contracts in, so I can get some growth in for a cheaper price and be able to maintain that. And number 5, I didn't put it as number 5, but for number 5, understand what? The risk. What are the risks? Number 5, what are the risks that I have? What are the risks that I have to navigate? These are the 6. These are the major 6 I've got. I know we got more. Y'all can put some more in the chat if y'all want to. Inflation, the Fed raising interest rates, Russian-Ukraine war, supply chain issues, mandatory COVID lockdowns and other health emergencies, and currency exchange risk. All right. Those are the main things.